We're analyzing Shopify, stock ticker SHOP, to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Shopify. Then we're giving a final rating to the business. Before we get into these valuable metrics, let's understand Shopify stock performance. Right now, Shopify trades for $63.17 per share. Year to date, Shopify stock price is up 80%. This is crushing the market. In the last 3 years, however, Shopify stock price is down 29% overall. Shopify is down more than 60% from their all-time highs in November of 2021. Going back to when they were listed just over 8 years ago, Shopify still delivered huge returns. Even with these recent declines, Shopify stock price is compounding at 47.5% annually. The company's stock is up nearly 22 times. Right now, Shopify trades just $4 below their 52-week high. The company is up $40 from their 52-week low. Shopify is a big business. They have an $82 billion market cap. But the burning question is, why should we be paying close attention to this former pandemic darling, Shopify? Shopify offers an e-commerce platform primarily to small and medium-sized businesses. The firm has two segments. The subscription solutions segment allows Shopify merchants to conduct e-commerce on a variety of platforms, including the company's website, physical stores, pop-up stores, kiosks, social networks, and Amazon. The merchant solutions segment offers add-on products for the platform that facilitates e-commerce and includes Shopify Payments, Shopify Shipping, and Shopify Capital. Shopify is also owned by a handful of value investors. Josh Tarasoft has 6.5% of his portfolio that shows up on his 13F in the business, and Tom Gaynor, CEO of Markel, has a very small position in the business as well. Now that we have that background, let's get into the numbers. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. A typical business earns about 7% returns on capital. Looking for a benchmark that's double this builds in margin of safety based off the quality of the business. Shopify's returns on capital have fluctuated over this time. They were positive in 2020 and 2021. However, they've been negative again in their most recent fiscal year. Averaged out over this time, Shopify earns negative average returns on capital. That might not be the end-all be-all for a fast-growing business, but we'd rather see them creating a lot of value through their reinvestment. Because these are negative, this is an X on metric number 1. Metric number 2, we're looking for growth in the business up until today. For this to be a check, we need to see growth in their revenues, net incomes, and free cash flows. All three have to be up. In this time, Shopify's revenues have increased by nearly 6 times. They were a major beneficiary of lockdowns in 2020. Since then, their revenue growth has continued. The company produced positive earnings in 2020 and 2021. In their most recent fiscal year, these earnings are negative. That's the same with their free cash flows, which were positive from 2019 until 2021, but are negative in their most recent fiscal year. When we look at the company's income statement, we can see this has a lot to do with their R&D expenses. Including up until today, Shopify has nearly doubled their R&D costs from 2021. They're investing very heavily in their business, even more so than they have in years prior. This high reinvestment is what's bringing down their net incomes and free cash flows. While it could seem unfair to penalize the company for this, and that this growth would be coming as a consequence of high returns on capital, because their earnings and their free cash flows are negative in their most recent fiscal year, this is an X on metric number 2. Metric number 3, we're looking at the company from the view of an individual shareholder by looking for earnings per share growth in the last 5 years. During this time, we learned Shopify's recent earnings are still negative. Shopify's also diluted shareholders by 20%. A lot of this is coming from stock-based compensation, which is not out of the norm for a lot of these high-growth tech companies, but can take away an ownership percentage from shareholders. Because their earnings are down and their shares outstanding are up, this is an X on metric number 3. Metric number 4, we're looking for free cash flow per share growth in the last 5 years. A similar story here. While the company did have positive free cash flows per share from 2019 until 2021, which was in very sharp contrast to a lot of these other stock darlings, their free cash flows are negative in their most recent fiscal year. This is another X on metric number 4. Things aren't starting off so hot for Shopify. We're 0 for 4 on our analysis so far. During economic downturns, it's overly levered businesses that are at the greatest risk of poor outcomes. We want Shopify's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow they produced in their last 5 years. Shopify has had negative net debt in all 5 of these years, meaning they're left over with cash after paying off all of their debts. Shopify ended last year with $3.7 billion in cash. Right now they have $3.5 billion. And during this time, Shopify has actually been cash flow positive. Even though their cash flows are down recently, Shopify has produced $676 million of free cash flow summed up through all 5 of these years. This is our first check of the day on metric number 5. Even with their recent cash burn, it looks like Shopify could be in a healthy financial position. The big metric of them all, metric number 6, we want Shopify's average 5-year free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we're estimating a fair value for Shopify. Right now, Shopify has a $78.5 billion enterprise value. This accounts for both their net debt and their market cap. It looks at Shopify similar to it being a private company. In their last 5 years, we learned Shopify produced $676 million of free cash flow, meaning they produce about $135 million in an average year. When that's divided by their $78.5 billion enterprise value, we get a very small 0.2% average free cash flow to enterprise value yield. That's coming in well below the yield of the 10-year treasury, significantly below the risk premium we'd be seeking. With negative free cash flows in their last 12 months, this is an X on metric number 6 for Shopify. But don't just throw this business out. We need to come to a more concrete estimate of Shopify's fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Shopify, which takes us on to using a discounted cash flow model to come to an estimate of their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Shopify's had a low degree of business predictability in their past, partially due to their very extreme growth. That impacts our assumptions here. We're starting with a 3-year average of Shopify's free cash flows from the years when they had positive cash flow and growing these into the future using historical assumptions. It's up to you to figure out if this will be accurate or not for the business. Realistically, this just gives us an estimate. Assuming they grow these free cash flows at a rate of 20% annually for the next 10 years, then in the decade from there, this growth rate is cut in half and they grow at 10% annually. If we add in Shopify's tangible book value, which gives an estimate of their net worth, if we're seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for, in addition to his margin of safety requirements. From today's valuations using those assumptions, an estimate of Shopify's fair value per share is around $11. That's down a lot from the company's current stock price. There are key points to keep in mind. Again, Shopify has a low degree of business predictability. A DCF model's not going to do the greatest with such a high growth business. However, it clearly looks like Shopify has to keep up a very high growth rate for a long time to justify their valuation based off their cash flows. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with a financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Shopify. But we have to address something first. We've covered the numbers, but the qualitative aspects of this business are just as important. What are they? Looking at the qualitative factors supporting a potential long thesis. Number 1, the company has many experts to help small, medium-sized businesses with website design, photography, and other elements of the process, and benefits from a large referral and development ecosystem. Number 2, Shopify is attractive for small, medium businesses because it is simple to use and has a wide variety of built-in features that make it a turnkey solution. Number 3, Shopify's growth has been strong and it's expected to remain so, with robust new merchant ads, increasing gross merchandise volume, and high attach rates. We'd be remiss if we didn't cover the negative aspects of the business as well. Looking at the factors potentially supporting a short thesis. Number 1, the build out of the Shopify fulfillment network will require substantial investment in both financial terms and management resources. Number 2, Shopify is exposed to the economic cycle with the high failure rate for core small business customers, in addition to the fact that retail volume could likely decline in a downturn. Additionally, management's strategy is to avoid going direct to consumers. Number 3, Shopify has traded at lofty valuations at times, and while it might continue to generate strong growth, the company may still fail to live up to optimistic assumptions embedded in its stock price. There you have it for a balanced perspective of some of the qualitative aspects of the business. Now it's time to give our final rating. In analyzing Shopify, stock ticker SHOP, we learned the business's revenues have grown a lot in the last 5 years. They're heavily reinvesting back into the business through its fulfillment network. While they had a few years of positive returns on capital, positive earnings, and positive free cash flows, they've once again swung to the negative through this reinvestment. Shopify's diluted shareholders by 20%, but they have a cash cushion on their balance sheet, and they've actually been cash flow positive in the last 5 years. It's worth reiterating this analysis is not financial advice. Looking at their free cash flow to their enterprise value yields, those didn't look attractive compared to the yield of the 10-year treasury. When we performed our discounted cash flow analysis from today's valuations, if you believe those assumptions and are looking for a 15% rate of return, based on their cash flows, an estimate of Shopify's fair value per share is around $11. It seems there are big growth assumptions still priced in for the business. That estimate could be understating things for the business, but it's still cut in half from their 52-week lows. Looking at all the factors of our analysis, Shopify looks like a weak candidate for further research. Don't let that discourage you if you're interested in the business. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Shopify, and let me know what business I should look at next in the comments below. Thanks for learning about Shopify with me, and have a great day.